The objective of every portfolio manager is to maximize returns while minimizing risk, which is what we will try to do in crypto space. If you have been following crypto news in the past few months, you may have noticed a race by various nations around the world to pass regulations aimed at monitoring activities in the sector. This comes at a time when Bitcoin ETF has been approved in the US years after Canada approved a similar instrument. The US, Argentina, Chile, UK, and many other key nations are working on draft regulations that could bring crypto from the periphery to the center, allowing capital to flow from traditional finance into the nascent sector. One major development is the ongoing tests by SWIFT, a global payments enabler to move its operations onto blockchains, with the help of Chainlink. We are on the cusp of mainstream adoption. To show the potential, Bitcoin has a market cap of $1.2 trillion. The most valuable US firm, Microsoft, has $3 trillion. When crypto approaches mainstream, we expect Bitcoin to rise to a conservative figure of over $2 trillion, or a quarter of gold's market cap, which is $15 trillion. If you are thinking of investing in the crypto space, here is how you may consider allocating your funds. Now, experienced portfolio managers always will advise that you start by identifying risky versus stable, or less risky assets. Risky assets also tend to exhibit high returns, while stable assets are safe but have lower returns. In the crypto space, Bitcoin is the least risky asset, followed by Ether and Solana. If those are too risky for you, then maybe crypto is not your cup of tea. So you want to diversify into both safe and risky assets for maximum returns. The riskiest crypto assets are the emerging altcoin projects. Based on the risk appetite of the investor, you will split the money into 3 units. If the investor has an average risk appetite, we shall allocate 50% of the money to safe assets like Bitcoin and Ether. Then 25% to mid-cap assets, these less volatile cryptos like Chainlink, Near, Avalanche, Cardano, among others, while the remaining 25% is in low-cap projects such as Bittenzer, Filecoin, Lockless INX, Funtico, etc. More information on these low-cap projects is available for free online. An alternative or more aggressive allocation would involve having 25% in Bitcoin, Ether, and Solana, then 50% in mid-caps, and finally 25% in altcoin projects, and finally a super aggressive portfolio would have 50% in low caps and 25% for safe assets and mid-caps respectively. Now the investor needs to know that we are in a crypto bull market in 2024 and must be careful to sell before the markets cool off, after which he can increase his holdings of the safe assets while reducing positions in small caps. Proper research. The investor must do proper research for each asset before allocating funds for each counter, especially the low-cap projects, which have the highest return on investment. The investor then needs to decide the duration which he will be holding the investments, whether it's long-term or short-term. A short-term option would involve timing to exit when the crypto bull run hits its peak. The investor will then monitor market movements from time to time to ensure that they get the best returns from their investments.